Hey guys, Mike here. So are the institutions warning us once again that there's about to be a major correction coming up? That's what I'm going to discuss in this video. And as usual, YouTubers' opinions shouldn't mean nothing on this unless they actually work on Wall Street, because when they say a market correction is coming, well, who causes that? Institutions, hedge fund managers, money managers, all that good stuff. And I did a video like this, you may remember it right here, January 26th, about this montage. It was between 3 to 28 days worth of, that was the timeline at least, for these money managers to basically warn us. And of course, what happened from January 26th to January 29th, we did a 5.5% sell-off on the NASDAQ. Then 12 days later, boom, over a 10% correction for lasted about 3.5 months. All right, I did not interject my opinion in that video. I would not interject my opinion in this video because it shouldn't matter. What matters is them, okay? And the reason why they put these kind of warnings out is to brace the impact of what a correction will do to their own clients. That way their clients can't call them and say, you didn't even warn us, right? And so they're putting it out there. Doesn't mean it's gonna happen, okay? But understand, you know, this is something that's usually, I'm starting to notice a pattern of this. When you start to see them for about a good 4 to 6 weeks talking up this stuff, usually happens within a few months, okay? When you see this many coming out. But I'm going to take you through those right there. Then I'm going to show you an Excel spreadsheet of which I went back in the S&P and I logged every sell-off over 5%, every correction, which of course is over 10%, and show you what months, and there's 3 of them, that are the most popular for these sell-offs and corrections, okay? And remember, I talk about this like it's nonchalant because sell-offs and corrections are just part of the market, all right? And so there's some are obviously in different length, but that's what they're here for. So let's go ahead, and then of course I'll end up on a good note with some good news, okay? So let's get into it.
I think we could expect at least a 10% correction. You know, we have historically high PE multiples here. We think the market is very top heavy, especially with the large cap growth stocks and some of the faster growing growth stocks. So we would think it's a time for caution, a time for conservatism.
And we think we are kind of moving into what we call this mid-cycle transition. That's faster than normal, Melissa. Normally it takes about 2 years for that to happen, but this recovery is happening so quickly that that's happening now. So I'll give you the years when we had a mid-cycle transition. It's 04, 94, 04, and 2011. And all 3 of those years saw about a 10 to 20% correction. So that's no guarantee that that's what's going to happen, but that's what we expect. Multiples should come down. And by the way, that's what should happen at this stage of any bull market in a recovery from a recession.
Well, look, our perspective at Morgan Stanley is that we are going to have this 10 to 20% correction at some point between now and the end of the year. But at the same time, we do think that that would be a viable correction. We're probably going to end up about where we are right now.
To the extent that these big cap techs that are now reporting cannot sustain new highs, and they all have upside risks, I totally acknowledge that. But if they cannot sustain these new highs, and given their predominance in the indices, that may be setting up for a sizable reversal.
Right, and Sven, you're looking at this from a technical point of view, but from a fundamental point of view, you do note that valuations are extremely stretched. You note that they're higher than they were at the peak of the 2000 bubble. We talked to a lot of guests about this, and many of them argue that it's not the same. You've got more bulletproof balance sheets, better companies coming, better quality companies in terms of listings, massive cash piles, and those strong fundamentals. So what's that telling you?
Well, it better be different this time, right? Look, in May, Neil Kashkari, the head of the Minneapolis Fed, actually said something very interesting. He said, you know, all my Wall Street friends are complaining that their trading models no longer work. He just mentioned the valuation. On a price to sales basis, tech is now over 7, which is higher than 2000. The S&P is over 3.2, which the general trend has been 1.5 to 2.0. It better be different this time because there's absolutely zero history of any of this being sustainable.
Yeah, Kelly, the market's grinding higher, but there are so many warning signs that we're in a dream market that is going to ultimately cause heartache for people. Not to pick on Jim Cramer, but this morning he was talking about the young people. He said they should put a bunch of money in the S&P 500 index and then they should buy 4 SPACs. Well, guess what? The S&P 500 index is loaded with overvalued growth stocks. Warren Buffett talked about this in his annual meeting. He said he showed the 20 largest cap companies in the world in 1989 and asked you, where are they now? The thing regurgitates, and the problem is the index way overowns those things.
The market internals, we've been talking about this for a couple of weeks. Traders have had a problem with the way the markets look. The momentum, the percentage of stocks above their 50-day moving average, momentum indicators have been slowing, although they're still strong. Breadth has been weaker. The advanced decline line's been a little weaker. New highs, they've been kind of crummy in the low single digits, 10, 20, 30 in the S&P 500. That's not much at all, given the fact the S&P is near a new high. The other thing, of course, we've been talking about, we did this last week, small and medium-sized stocks have been underperforming really since April or May. Look at the Russell 2000. It's 10% below its recent 52-week high. The S&P mid-cap is 8%. The Dow Transport's 12%. This is a little worse today, but this was going on for the last couple of weeks, and we've been talking about it. So it wasn't like this weakness has appeared out of nowhere. Active traders, call active traders. They'll tell you, this is a really tough market to make any money in. They've been saying this for weeks. Lowry over the weekend, oldest technical analysis service in the United States, been reading their work for decades. They said the body of evidence reflects an investing environment where it's difficult to find attractive stock to buy, whether from active traders. They'll tell you, this is a really tough market to make any money in. They've been saying this for weeks. Lowry over the weekend, oldest technical analysis service in the United States, been reading their work for decades. They said the body of evidence reflects an investing environment where it's difficult to find attractive stock to buy, whether from new money or cash raised from the pruning of weaker stocks.
So if you shouldn't try to be a hero, what does that mean? What if you have money that you want to put to work? Are you telling people not to do it? Or are you just saying don't sell out of the positions that you have?
I just think July's, at least in my 30 years of doing research, have never been great months for people to really make big profits. So it is and I think you guys kind of hit it on the head. There's a lot of uncertainty. And the one thing I don't think people should do is think that this is sort of the end of the expansion and the bull market. But yeah, for the next couple of weeks, I think it's tough. I mean, July was tough last year, and July is proving to be tough again. And, when markets are strong in the first half, July tends to be pretty choppy, and I think that's playing out pretty textbook.
And so now just kind of looking at the spreadsheet as far as sell-offs and corrections here, you can see there's 3 months from 2011 through first part of 21, you should say, that January's got the most, May, and then the big whopper is in October, which obviously is coming up in a couple of months. You've had 5 of those, which were 2012, 2014, 2015, 2018, 2020. And so, it is coming up right around the corner. We've had, only one in July, one in August, one in September. And so I thought that was interesting to look at that. So I'm definitely eyeballing October for sure for the S&P. And then if we look at the Russell 2000 index, nobody's really talking about this. It's slowly from June 25th up to this day already had a correction of, which is over 10%. It marked that yesterday. And you see it broke through the trend line, which drawn from the market crash through today. And so it was bouncing off that, and it was way above that trend line, came back down and broke through it yesterday. So that's something else to keep an eye on, because you can see right there, it's totally oversold. But the MACD is still looking bearish. And so, of course, that, leaves us with the NASDAQ and the Russell now having gone through corrections for 2021. And so what does that leave us with? The S&P and the Dow being the 2 indexes that have not. And so that's why everybody keeps looking at them, because they keep setting all-time new highs. And I've said it before and I'll say it again. What's healthy for a bull market? Corrections. This is the norm. And so that's why a lot of people are expecting that. That's why you see a lot of puts being bought on the S&P, or the SPY, excuse me. So, that's a big thing to watch. So now, as usual, just like I ended that first video in January, because this is not a scare video, let's end with some positive news.
I think that stocks are still going to have a double-digit second half. So any sell-off we're seeing in July is not something that you have to dig, the market has to dig itself out of. But you're absolutely right. I mean, in a month when markets wobble, we have a buyer strike. Commodity stocks were leading year to date, so they're vulnerable to profit taking.
We started the show with a question, Julian, and that is what does the 10-year yield lowest level since February or so tell you? And couple this with, of course, markets sitting pretty much at record highs across the board. What do you think the message is?
The messages are somewhat mixed. And actually, if you think about it, that is consistent with a market that, in our view, is likely to take a pause within the context of a market that, looking at a year or two from now, is likely to be substantially higher than where it is.
And so, you know, that's the way it works, right? You do a correction and the market hits higher. So you see both of those gentlemen, and one has done research for a long time. I mean, pretty spot on with a lot of stuff he says. You know, they're expecting, you know, this bull market to continue. It just has to have a breather at some point in time. Okay, that's actually okay. That's why you just got to make sure you have dry powder. Again, not financial advice here, but you know, dry powder on the sidelines, money. I'm talking about. You know, but the one thing that's interesting, if you look, I was trying to figure out where the money's going right now because usually there's a rotation somewhere. But if you look, energy stocks have been killed. Crypto is, you know, right now going down. It's been going down for what, 3 months now? And so, you know, people rotate, you know, cruise stocks, airlines, these stay-at-home plays, growth stocks. There's no rotation into anything right now. I don't know where the institutional money is going. I'm looking for it. If you happen to discover something and you think you know where it's going, let me know. I don't see people in bonds. I mean, it doesn't make a whole lot of sense. And so, you know, it seems like a lot of people are in cash right now, just waiting to see what happens. I'm seeing all the puts being bought on the SPY. Usually, I think the two bigs I saw for next month, between like August 16th and August 22nd, somewhere in that time frame, I believe. And so, I did find it interesting that the SPY puts are these. A lot of people had bought these inverse ETFs that were basically shorting the S&P, and there was some big people buying into these. Well, it's funny, they expired Friday. Well, when did the big, you know, sell-off happen? Yesterday, which is Monday. And so I find out, it's like, is that a coincidence or not a coincidence? I'm like, come on, I don't think so. Those puts expired Friday, and then the major sell-off happens on Monday. Like, that's a big coincidence, right? Because there was some big bets being made. And so, I don't know, who knows? But anyway, maybe I'm just a conspiracy theorist. I don't know. But I just want to put this out there to you so at least you're aware of it. This is not a fear-mongering video. My opinion is not in this. You see, you listen to those guys. And so we'll see if this one holds true just like the one did in January. And like these guys said, there's no way to time this. You don't know when it's going to happen. It's going to be this month, August, September, October. Obviously, the big month for this to happen in. Could be. And so anyway, hope you got something out of it. Hit the like and subscribe button if you did. Really appreciate that, guys. Hope you have a good day, and I'll see you later. Hit that link down there in the bottom of the description. Open your account with BlockFi. You can earn interest there. Also, they're getting ready to start rolling people off the waiting list for their credit card where you can earn Bitcoin on your purchases, and it is a 0% annual fee, so it doesn't cost you anything to actually have.